Good day, students. This is review question 4.4 on the topic of budgets. It reads as follows. The following information relates to computer manufacturers who produce keyboards for elderly. We are given the actual information for the year ended 31st of October 2014, which means the end of the accounting period for this company is 31st of October each and every year. We are given their sales, which is 15,000 units at 75 rand per unit. It means in the year 2014, the product that they are selling was being sold at 75 rand per unit. And under number 2, 13,600 units were manufactured in the year 2014 during that year. And we are given direct material consumed, which was 6,800 kilograms at 2 rand 50 cents. It means in order to manufacture the 13,600 units, we used 6,800 kgs of material, and the 6,800 kgs of material was bought at 2 rand 50 cents per kg. Then it continues by saying that direct labor amount to 34,000 hours at 1.2 per hour. So now their direct labor amounted to 34,000 hours at 1 rand 20 cents per labor hour. Then we are told under number 5 that manufacturing overheads were 7,480 in the year 2014. Then we are given the closing balance, and the closing balance is on the 31st of October in the year 2015. So now these are the closing balance, and the closing balance in terms of direct material was 3,900 kgs, and the finished goods closing balance was 2,400 units. So now let me just make some continuation to the next part. Then it says budgeted information for the year ended 31st October 2015. That means at the end of October 2015. So now that means there must be a correction with the date. Under number 6, there must be a correction because this date is 2014, not 2015, the end of the year, which is October 2014. Then after we continue to 2015. Under number 1, it says sales units are expected to increase by 5%. Sales units are expected to increase during the year by 5%. Remember, there is actual information that took place last year. Last year, there was 15,000 units that were sold. And now we expect that 15,000 to increase by a percentage, which is 5%. Therefore, now that will be the budgeted sales for the year 2015 up to 31st of October 2015. And the selling price per unit is also expected to increase by 6%. Expected increase is 6% on the selling price per unit. And the last year's selling price per unit was given as 75 rand per unit. That was 75 rand per unit. So now we must also add 6% here as an increase, because in the year 2015 we expect that our selling price will increase by 6%. Then under number 2, it says that direct material will be consumed in the same ratio as 2013 and 2014, with 40% increase in the price per kilogram. So now that means our direct material per kg is expected to increase. And remember that our direct material was under number 3. We were told that direct material consumed was 6.8 kgs in total, but the cost price was 250. It means we just have to add 40% because we expect an increase of direct material by 40%, which is direct material per kg. Then let us continue to number 3. Number 3 says, according to a new labor agreement, direct hours will be 15 per labor hour. Direct labor will be 15 per hour, which is 15 rand per hour. Then that must be rents there. Whereas the number of hours required to manufacture one unit will be 20% less than in the previous year. So now that means the number of hours it takes to complete one unit will decrease by 20% when we compare that with the previous accounting period. So now that means we will need or will have to be able to calculate the number of hours it takes to complete one product, because we don't know how many hours it takes to complete one product. So now let us continue with that, then we'll see when we are done with this exercise. Then number 4 says that the manufacturing overheads of the unit manufactured will be in the same ratio as in that of 2013 and 2014 year. Then we are given the closing balance, and the closing balance is on the 31st of October 2015. And this closing balance are very important when it comes to budgets. So now this is the closing balance of the inventory on the 31st of October 2015. And the closing balance in terms of raw material is 3,400 kgs, and the finished goods is 3,900 units that were left in the storage by the end of October 2014. So now remember, in the previous year we have seen that there was also closing balances, and I said we must make adjustments with regard to the closing balances. Under number 6, this is where I want to emphasize. There were closing balances, and I said these closing balances are for the year 2014, not 2015. That is correction that needs to be made. So now remember, if this is the closing balance on the 31st of October 2014, it means it becomes an opening balance. These amounts will be opening balance for the year 2015. This will be opening balance for the year 2015, because the year 2015 starts on the 1st of November 2014. So now this will be the opening balance for the year 2015. For the year 2015. And remember, the year 2015 start on the 1st of November 2014. So now the year 2015 start on the 1st of November 2014. That means the closing balance on the 31st of October 2014 becomes an opening balance on the 1st of November 2014, which is the opening balance for the accounting period that will end on the 31st of October 2015. So now that is why these closing balances will be opening balances for the accounting period ending 31st of October 2015. Please take that into account, because opening balances and closing balances are very important in the topic of budgets. So continuing in that note, we are required now to do the budgets, and in our requirements it says that prepare the following budgets for Compu manufacturers for the year ended 31st of October 2015. So now the first budget is the one that is called sales budget. So now sales budget, we know that we are looking at the value of the amount of sales, or the value of sales that we expect the company to receive. So now we start with the sales budget 4.4.1, 4.4.1, which is our sales budget. Our sales budget, and our sales budget says that expected sales, which is the sales that we expect to make, we multiply that by the selling price per unit. Multiply by selling price per unit. And we know that our expected sales is the previous sales plus 5% increment, because we expect in the 2015 that our sales will increase by 5% from the previous sale that we made last year, which amounted to 15,000 rands. So now, meaning that when we calculate our expected sales, we will say the amount of sales from the year 2014 times by 5%, because our sales are expected to increase by 5%. Then we times that by 105%. Therefore now 105%, that will give us the amount of sales. We say 15,000 multiplied by 105 divided by 100. Then that gives us 15,750. 15,750, which is the sales in units. 15,750 units. Then now we continue with our sales budget. Then it will be 15,750. And we multiply that by the selling price per unit. And remember, our selling price per unit previously was 75 rand, and it was expected to increase by 6%. So now we must also increase our selling price per unit, and our selling price per unit was 75 rand, and we multiply that by 106%, because we are adding 6% to 100. Then that will be a total of 75 multiplied by 106 divided by 100. Then that will be 79 rand 50 cents as our selling price per unit. 79 rand 50 cents. So now we go and we write that amount. Then we get the total expected sales, 79 rand 50 cents. Therefore now our expected sales will be the total of 15,750 times by 15,750. That gives us the total of 79 rand 50 cents times by 15,750. That will be 120 or 1,252,125. So now that is our total expected sales, or our sales amount. That is our sales amount, and that was the first requirement. Then now we go to the second requirement. The second requirement is to calculate the direct material usage budget, which is in quantity. That means we need to know the number of kgs that are needed to produce the required units. So now, before we go to the direct material usage, we first have to start with the production budgets. You can't do the direct material usage budget without doing the production budget. So now that means our workings will be production budget before we can do direct material usage budget. So now this is our workings, which is production budget as our workings, because we cannot skip this budget workings, where we start with the production budget, so that the production budget will tell us how many units must be manufactured. Production budget, and production budget says estimated or projected sales. It starts by saying projected sales, and our projected sales is the one that we calculated, 15,750. That is 15,750, the number of units that we expect to sell. Then after we add the closing stock plus closing stock, because closing stock is the units that were manufactured in the current period, and our closing stock come from the given information. Our closing stock will definitely be in the current year, and our closing stock will be 3,500 units. Remember, we are looking at the closing inventory in terms of stock, not the raw material. Then we take the closing stock as 3,900. Then we say plus 3,900. Then that will give us units required. That will give us units required. Units required. And our units required will be 15,750 plus 3,900, and this will be 19,650. 19,650. Then from here we have to subtract opening stock, less opening stock, less opening stock. Why do we subtract opening stock? Is because opening stock was not produced in the current year. It was produced in the previous accounting period, and it was the closing stock of last year, and it became an opening stock in the current year. So now we are not producing opening stock because it was already produced in the previous accounting period. That is why opening stock must be subtracted whenever you are doing production budget. Then now we go and check our opening stock. Our opening stock come from the previous accounting period, the closing stock of last year, and the closing finished goods of last year were 2,400 units. It was closing balance on the 31st of October 2014, and that will be an opening balance on the 1st of November in the year 2014, which is the beginning of the 2015 accounting period. So now we say minus 2,400 units. Then that will give us production requirements. That will give us production required, which is the number of units that are required to be produced in the current period. Production required. So now our production required will be 19,650 minus 2,400, and this will be 17,250. And these are the number of units that are needed, or the number of units that will be produced in the current year. So now if these are the number of units that will be produced in the current year, then we'll use that to do our direct material budget or material usage budget. So now from here we can do the material usage budget, and that was 4.4.2. Then we start with our 4.4.2 material usage budget. Material usage budget. So now under material usage budget, we start with the production required. We start with the production required. That is why it is necessary for you to understand that you first have to calculate production budget before you do material budget. Then now we start with the production required or production requirement. Production required because we need to produce 17,250 units, and for us to produce these units we need kgs of material that will exactly manufacture the 17,250 units. So now we have the number of units that we need to manufacture. Then we need to know how many kgs of material are needed to manufacture these units. How many kgs of material are needed to manufacture these units. Therefore now we have to say multiply by kgs of material per unit. Kgs of material per unit. Let us check if can we be able to find the kgs of material that are needed to manufacture these units. Let us go and check from our given information. From the budgeted information, there is nothing that speaks about the kgs of material per unit. We don't have anything. We only have 40% of the increase in the price per kg, and we'll do that later. We are looking for the kgs of material that are required to produce one unit. And what do we know? We know that in the year 2014, 13,600 units were manufactured. And we know that 6,800 kgs of material in total were required to manufacture the 13,600 units. But now we need to calculate the number of kgs that are needed to produce one unit, not the total kgs that are needed to produce 13,000 units. So now for us to do that, we have to do some calculations, and when we do these calculations we have to say these are the kgs that are needed, or the kgs in total that were required to manufacture the 13,000 units. But we need to know the kgs that are needed to manufacture only one unit. So now to do that, it is very simple. We say kgs per unit is equal to kgs in total, 6,800 total kgs, divide by the units that were manufactured using those kgs, which is 13,600. Therefore now, meaning when we do our calculations, we just say 6,800 divide by 13,600, and that will give us 0.5 kgs. That means it takes 0.5 kgs, or we need 0.5 kgs to manufacture one unit for this company. So now we have done that. Then we can go to our material usage budget. Then we multiply by the material kgs, or the kgs of material per unit, and we have calculated that the material kgs per unit is 0.5 kgs. Then we multiply by 0.5. Therefore now this will give us the total kgs of material that are needed to manufacture 17,250 units. That is the units required to be manufactured in the current accounting period, which is the year 2015. So now we multiply the two to get to the material that we need. Multiply that by 17,250. Then that will give us 8,625. That will give us 8,625. That will be 8,625. And that 8,625 will be the kgs that are required to produce the 17,250 units. Then that will be material required for production. Material required for production. Material required for production. material required for production. And the material that is required for production is 8,625. Now don't forget, the same principle does not change. There was material that was in the business at the beginning of the year already. There was an opening balance of material. And remember, the 8,625 include also the material that was already in the opening balance. So now we have the material that was in the opening balance, and that material was 3,900 kgs, and we don't need that material because this material is already there. It was brought from the previous accounting period. So now we have to say opening balance must be subtracted because we don't need to buy this. It is already in the storage. So now that is why opening balance must also be subtracted in this budget. Then we say less opening balance, then we have to add the closing stock. Let us start by saying plus closing stock, because closing stock is the one that was bought in the current period, plus closing stock of material. Remember, we are referring to material in this exercise or in this budget. Then our closing stock is given under the budgeted information, and our closing stock is 3,900, and our closing stock is 3,400 kgs of material, and our opening material is 3,900. So now we add the closing stock and we subtract the opening stock because opening stock comes from the previous accounting period. Then plus closing stock, which is given as an amount of 3,400, we add the 3.4, 3,400. Then that will give us the total material requirements. Total material requirements, which is the total material that we require. Then it will be 8,625 plus 3,400, and this will be 12,025, and we less the opening stock because opening stock was there from last year. Less opening stock, and when we less the opening stock, we'll get to the material that is needed for production, the one that must be bought in the current year for production. Our opening stock is given as an amount of 3,900. There is our opening stock 3.9, and we subtract the 3,900. Then after we draw the line at the end, then immediately when you draw the line, you calculate the balance minus 3,900. Then this gives us the total of 8,125, and that is the material that should be purchased. Purchases in kg. You can say purchases in kg. Purchases in kgs. This is the material that we need to purchase for the current accounting period. The material that must be purchased. Purchases in kg, or the material that must be purchased and be used in production. Then that was the material usage budget, and it's very important to know that you take the production requirement, and the production requirement comes from the production budget. As it is, these are the units that are needed for production. Then after you bring that down, then you multiply by the kgs of material if you are dealing with kgs, but those kgs of material must be per unit, then those kgs became 0.5 kgs. Then after you multiply, you will get to the total material required for production. So now this is material that is required for production. Therefore now if that is material which is required for production, therefore now we also have to add the closing stock, because closing stock is the material that was left from the current accounting period. Then after we get to the total material that is required, then after we subtract the opening stock, because opening stock is the material that came from last year, and we don't need material that come from last year because it is already in the business. We don't need to buy it. Therefore now that will give us the material that we need to purchase in the current accounting period. Therefore now we go to the next budget or to the next requirement, and the next budget is, or the next requirement or required budget is the direct material purchase budget, and this is value, meaning the budget that we did is the quantities. The budget that we just did is the number of kgs. This is in kgs. These are the kgs of material that must be purchased. Purchases in kgs. Kgs of material that must be purchased. So now we are looking for the cost. How much is this material going to cost us? Therefore now the budget that we are doing will answer that question. How much will this material, which is 8,125 kgs, how much will this material cost us? Then that brings us to the next requirement, and that brings us to the next answer or the next budget, which is 4.4.3, where we must do the direct material purchase budget. Therefore now we are calculating this budget, calculating the cost of the material that must be purchased. So now it means obviously these two budgets, they have a direct link. Then we are calculating the direct material budget, 4.4.3, direct material budget, which is direct material purchases budget. Direct material purchases budget. Direct material purchases budget. So now it means we first have to start with the purchases that come from the previous budget. Therefore now it will be purchases in kgs. Purchases in kgs. Remember, we need to buy 8,125 kgs of material. This is what we want to buy. We want to buy these kgs. Therefore, now we need to know their total cost, 8,125. 8,125 kgs. This is what we want to buy. Then we have to multiply this by the cost of material per unit. The cost of material per unit. Cost of material per kg, not per unit, per kg. We need to know how much are we paying per kg for this material. Therefore now we have to go and check the cost price of the material per kg, not per unit, per kg. And our material cost per kg was given in the year 2014. And the material cost per kg was under number 3. And it was R2.50 per kg. And we were instructed that our material cost per kg will have to increase by 40%. That was number 2. Direct material will be consumed in the same ratio as 2013 and 2014 year, with 40% increase in the price per kilogram. per kilogram, and this is the price of the material per kilogram, which is the kg. This is the price of the material. Therefore now we have to say 2 rand 50 cents times by 140%. That will give us the increased price of the material. Then this will be 2 rand 50 cents, 2 rand 50 cents times by 140 divided by 100, and this gives us 3 rand 50 cents per kg. So now this is the expected cost of material per kg. Then we come and we multiply by the 3 rand 50 cents per kg. 3 rand 50 cents per kg. So now this will give us the total material cost, or the total material purchases. Then this will give us the total material purchases. Total material purchases, which is the cost that we expect to incur in terms of buying material, times by 8,125, and this will be 28,437 rand 50 cents. So now this will be the expected or the budgeted cost of material in total. Therefore now we must go to the next requirement once again. The next requirement requires us to calculate the direct labor budget in rands. The direct labor budget in rands. So now we need to know how much will be the budgeted or the expected direct labor cost for this year 2015. So now we go to the direct labor budget, and direct labor budget is also linked with another budget, 4.4.4 direct labor budget. Direct labor budget, and direct labor budget starts with the production requirements, or production required. Production required. Remember, production required is the budget we did as our workings. This budget is very, very, very important, because if this budget is wrong, all the budgets will be wrong. Because we calculated here the production requirement, which was 17,250, and we used that to calculate our material usage budget. And now we are doing labor budget, and again we start with the production required, and the production required is the one that comes from the production budget, the 17,250. This budget is very important, because if it's wrong, everything that you do will be wrong. Then we have 17,250. Therefore now remember, we are looking for the total cost of labor. And for us to do that, we need to know how many hours of direct labor it takes to complete 1 unit. So now we have to go and check to the given information if how many hours does it take to complete 1 unit of this product. So now let us go and check how we can calculate that. From the given information above, let us check if are we given the number of labor hours or not. If we are not given that, then we'll see how we can calculate. When it comes to labor, we are given under number 4 that direct labor amounted to 3,400 hours at 120 per hour. So now this is the labor rate per hour at 1.2 per hour. And we know that the direct labor that amounted to 3,400 hours it was for the production of 13,600 units, because in the year 2014 they produced 13,600 units, and to produce these 13,600 units they spent 3,400 hours of direct labor. So now if we have this information, it definitely means we can be able to calculate the number of hours it takes to complete one unit. Why? Because we know the total number of hours, which is 3,400 hours, and we know the total units that were manufactured using the 3,600 hours. So now it means for us to calculate direct labor cost per unit, so direct labor hours per unit, direct labor hours per unit, we need to say the total hours, and the total hours is 3,400 hours. The total hours is 3,400 hours. So if we say the total hours and the total units, we divide by the total units that were manufactured, that will give us the number of hours it takes to complete one unit. Therefore, now we say 3,400 hours, we divide this by 13,400 units, and this will give us the number of labor hours it takes to complete one unit. Then we do that calculation. We say 3,400 hours divided by 3,400 divided by 13,600. Sorry, 13,600 units. 13,600 units. 13,600 units. And this gave us 0.25 hours. That means it takes 0.25 hours to complete one unit. 0.25 hours per unit. Last year it took 0.25 hours to complete one unit, and there was information regarding the labor hours. In the current year, we expected that the number of hours required to manufacture one unit, the number of hours it takes to manufacture one unit, and we know that last year the number of hours it takes to manufacture one unit was 0.25, and they say in the current year it is expected that it will be less than in the previous year by 20%. It means we must reduce now our labor hours per unit by 20%. So now it means we have to reduce, and when we reduce, we just have to say 0.25 times by 80%. Remember, we are reducing from 100% by 20% to 80%. Therefore, now that will just give us the straight correct amount. We will say 0.25 times by 80%, and this will give us 0.2 hours per unit. 0.2 hours per unit. Or if you want, you could have said 0.25 times by 20%, 0.25 times by 20 divided by 100, and this could have been 0.05. Then after you say 0.25 minus 0.05 minus 0.25, and we still get to the same amount, 0.2 hours per unit. So now we know how many hours it takes to complete one unit, how many hours of direct labor it takes to complete one unit. Therefore, now since we know the production requirement, meaning the number of units that are required to be produced. Then we can multiply that by labor hours per unit to get the total hours that are needed to manufacture the 17,250 units. Then we multiply by labor hours per unit. Labor hours per unit. And we know that labor hours per unit is equal to 0.2. Then we say 0.2 times by 17,250. That will give us 3,450 hours. 3,450 hours. And that will be called total direct labor hours required. Total direct labor hours required. Total direct labor hours required. Which are the hours that are required to manufacture the 17,250 units. Remember, 17,250 is units. These are units, and these are hours that are required to manufacture the 17,250 units. Then after, we have to multiply by the rate so that we get the total cost of direct labor to manufacture this product. Then we say multiply by direct labor rate per hour. Direct labor rate per hour, and our direct labor rate per hour is also given. Our direct labor rate per hour, I think it was given as 15 rand somewhere. Yes, it said that according to a new labor agreement, direct labor will be paid 15 rand per hour. That is rand, 15 rand per hour. So now that is the 15 rand, and there was no increment. That is what was given. Then we just multiply by 15 rand per hour. 15 rand per hour. 15 rands per hour. Then that will give us the total direct labor cost. Total direct labor cost will be the answer. Multiply that by 15, and it gives us 51,750. That will be total direct labor cost. Total direct labor cost. Total direct labor cost. Then that was requirement 4.4.4 that we have just answered. We have calculated our total labor cost. Remember, very importantly, you first have to know the production required, which is the number of units that are required to, or that are required for production. Then after, you multiply by the labor hours per unit, which is the number of hours it takes to complete one unit. So that after we multiply by the labor hours per unit, then we'll get to know the total hours of labor that are required to manufacture the 17,250 units. These are the total hours of labor that are required to manufacture 17,250. But employees will work 3,450 hours, and they will be paid 15 rand for each and every hour that they work. That means if you say the number of total hours that the company will incur, we multiply that by the rate, then that will give us the total labor cost for a specific job. Therefore, now that will be the production budget. That will be the production budget. So now let us move slowly to the next budget, and we'll see what the next budget has for us. Then the next requirement tells us that we should calculate the manufacturing overheads budget, which is in value. The manufacturing overheads budget. And again, the manufacturing overheads budget also start with the production required. Manufacturing overheads budget also start with the production required. That is 4.4.5. 4.4.5 manufacturing overheads budget. Manufacturing overheads budget. Overheads budget. Then we start again with the production required, because these are the units that are required for production. Whatever we plan is based on what the production requirement says. Production required is 17,250. Then we have to multiply by the overhead rate per unit if we are given per unit. If it's given to be per labor hour, then we use the per labor hour. But when it comes to our overheads, we were not told how are our overheads allocated, or in what base are our overheads supposed to be allocated. So we don't know the base. And whenever we don't know the base, we only know that under number 5 that manufacturing overheads were 7,480. And this was the cost of the overheads that was incurred, 7,480. And the 7,480 was incurred in order to manufacture 13,600 units in the year 2014. So now we need to calculate our overhead rate per unit, because we know the total cost of the overhead that it was 7,480, and we also know that 13,600 units were manufactured. It means for us to incur the 7,450, it was dependent on the number of units that were manufactured in the year 2014. Therefore, now we need to calculate our overhead per unit. Then we have to calculate our overhead per unit, and in calculating our overhead per unit, we say overhead per unit, and our overhead per unit will be the total overheads 7,480 divided by the number of units that were manufactured, 13,600, and we do that calculation. 7,480 divided by 13,600. This will give us 55 cents per unit. That means it costed the company in terms of overheads 55 cents for every unit that they manufacture. So now we have calculated, or we have already recorded our production budget, our production required. Remember, these are the units that are expected for production. Then we multiply that by our overhead per unit. Our overhead per unit. And our overhead per unit is 55 cents, as we have just calculated the 55 cents per unit. Then we multiply by the 55 cents. Then that will give us the total overhead cost to manufacture 17,250 units. Then the answer there will be total manufacturing overhead cost. Total manufacturing overhead cost. Manufacturing overhead cost. and the total manufacturing overhead cost is times by 17,250, and it will be 9,487 rand 50 cents. That will be the total manufacturing overhead cost. And that was requirement 4.4.5 that we just answered. So now let us go to the next requirement, which is almost the last, and it is really the last requirement. 4.4.6. We are required to calculate manufacturing cost per unit. Remember, manufacturing cost must have direct material, it must have direct labor, and it must have manufacturing overheads. These are the main three elements of a production cost. So now, even if you are doing manufacturing cost per unit budget, it still does not change the fact that we need the element of direct material, we need the element of direct labor, and we need the element of the manufacturing overheads. All the three elements are very critical, and they will also be part and parcel of our calculation. So we need the full manufacturing cost, but it must be per unit. So now let us go straight to our calculations. Then in our calculations, let us go to the fresh page. We calculate our manufacturing cost per unit. Our manufacturing cost per unit. And that is 4.4.6. Manufacturing cost per unit. Manufacturing cost per unit. And it must be per unit. We need direct material. We need direct material. We need direct labor. We need direct labor per unit. And we need manufacturing overheads per unit. Manufacturing overheads per unit. So now let us go straight to our calculations and check what the information says to us regarding all these costs that we have taken into account. So now we have to go and check to our direct material cost per unit. We know that it takes 0.2 kgs. It takes how many kgs to complete 1 unit? We have calculated that before in the direct material budget. The direct material budget told us how many kgs, how many kgs do we need per unit. In the direct material usage budget, we realize that we need 0.5 kgs of material per unit, and those kgs of material, they cost the company 3 rand 50 cents. Those kgs of material, they cost the company 3 rand 50 cents. Remember, we did all the calculations. So now if it costs the company 3 rand 50 cents to buy 0.5 kgs, therefore now it means per unit 0.5 kgs, you multiply that by the cost per kg, which is 3 rand 50 cents. That will give us the cost of material per unit, because we need 0.5 kgs of material per unit, and those 0.5 kgs of material are purchased at 3 rand 50 cents. So now that is why under direct material cost per unit, we have to say the material cost per kg, which is 3 rand 50 cents. This is the cost of material per kg based on our estimation. Then we multiply that by the required kgs, 0.5 kgs per unit. then that will give us the material cost per unit. So now we say 0.5 kgs, 0.5 kgs multiplied by 3 rand 50 cents, and this will give us 1 rand 75 cents of cost of material per unit. 1 rand 75 cents of direct material cost per unit that the company will have to incur. Then after we come to direct labor, and direct labor we need to know how much are the employees paid per hour. And as far as I know, the employees are paid 15 rand per hour. We did calculate that, and we did show that employees are being paid 15 rand per hour, and that was shown there 15 rand per hour under the direct labor budget. Remember, we said that employees are being paid 15 rand per hour, and even under our information we were told that employees will be paid 15 rand per hour, and we said it takes 0.2 hours to complete one product. We said it takes 0.2 hours to complete one product, and that was shown in our calculation, 0.2 hours to complete one product, and that was labor hours per unit. Labor hours per unit that we did here, labor hours per unit, and we said those hours is 0.2. So now if you say the number of hours per unit, we multiply that by the rate per hour, that will give us the direct labor cost per unit. 0.2 hours per unit times by the rate per hour, that will give us the direct labor cost per unit, multiply by 0.2, then it will be 15 rand per hour times by the number of hours it takes to complete one unit, which is 0.2, and that will be 3 rand. That will be 3 rand. It will be 3 rand. Then if it's 3 rand, we record under direct labor as 3 rand per unit. Our overheads were already per unit, if I still remember. When you come to our overheads, we calculated 55 cents. That was our overhead per unit. It was 55 cents, and it was already per unit, not per labor hour or per anything, but it was already per unit, meaning that our overheads is just 55 cents. And we say 55 cents, and from here we can draw the line, then that will give us total cost per unit. That will give us total cost per unit, and our total cost per unit will be the sum of 1 rand 75 cents, 1 rand 75 cents plus 3 rand plus 0.55 cents, and this will be 5 rand 30 cents. And I think that was the last part. Guys, budgets are very, very important. I will always highlight that. Go through this video, it will help you very much. We have covered all that was required. Let us just go and confirm if is everything taken into consideration. Yes, we have covered all the requirements that were necessary, and from here now I can say thank you on my side. Hope you'll enjoy this video. Bye bye.